I'm Don Tapscott.
And I'm Alex Tapscott.
This is What's on Tap. A lot on tap this week for sure, Alex. I think the big news, of course, is that China has been banning Bitcoin, cracking down in all kinds of other ways, shutting down crypto on-ramps to Alipay. What are they up to? Are they, gearing up to move towards the DCEP, their central bank digital currency? Are they worried about leaving the money? Are they worried about losing grip of the financial system? What's your view on this?
Yeah, well, China hasn't had a positive view on this industry and asset class for some time. In 2017, they banned onshore crypto asset exchanges, but it was still possible for many Chinese people to move their money offshore to other kinds of exchanges and to transact in crypto assets. And they often used services like Alipay to do that. Alipay is like a bank, and many other and much more to about 400 million or more people in mainland China. So this decision recently that they made to basically tell these big on-ramps like Alipay to stop enabling people to move money into crypto asset exchanges is part of a long trend of measures and actions that they've taken. This most recent one is not so much a new law as it is just a reminder, a new direction coming straight from the People's Bank of China. So that combined with some other jitters in the crypto market has caused Bitcoin to swoon a little bit as a result. The more interesting piece of news, I think, is actually that we're seeing more and more of a broader crackdown on Bitcoin mining. Bitcoin mining has been historically very prevalent in China, largely because of its bountiful renewable hydroelectric power and also some cheap coal. And we've seen just recently the Sichuan province, which historically has been pretty positive or pretty neutral on Bitcoin mining, saying that they, along with many others, are going to try and reduce the amount of Bitcoin mining that takes place in the province and therefore in the country. So what does this all mean? That's sort of the most important thing. Well, number one, I do think that the Chinese government is not a fan of Bitcoin because it is a tool that allows people to operate outside of the traditional financial system, which means that they don't have as much information and therefore as much kind of control over what's happening. Understandable. There's also strict capital controls in China, so they don't want people using these on-ramps to move money out of the country and into other places like, say, the US or Singapore or elsewhere. And in addition to that, they've got a lot of, chips on the table or eggs in this basket of launching their own central bank digital currency. And they've engaged, as much as they've told Alipay and others not to enable crypto asset on-ramps, they've now basically integrated their entire database of all of their customers into the project for the DCEP. And so that is clearly an example of where the direction is that they're going. Now, I think we've talked about this before, where in my view, and I think in your view, there's real value and real utility to Bitcoin for a lot of people. But there's also an opportunity for these central bank digital currencies to exist alongside of those if the right kinds of conditions are met around, privacy and certain kinds of financial rights. That's a far from certain outcome for most countries, but I do think that's a possibility. In China, clearly they're favoring the central bank digital currency over Bitcoin. So what does this mean for blockchain and Bitcoin in general? Well, because of all of this dislocation in the mining network, the hash rate, so the amount of computing power that's required to validate the network, has declined. And that's because a lot of miners are shutting down. Also, the price has some impact on that. But longer term, I think this is probably a very big positive. And the reason for that is that it's going to cause a lot of Bitcoin mining to move from China, one single country, and one that has a different political system than the one we live in, to other kinds of places like the States, Canada, Iceland, and other sort of democracies. So that's a big positive. Number two, in general, it's going to move into more regulated energy markets. And where you have more regulated energy markets, you've got more of a push for renewables and less of a push for coal and other kinds of dirty power. So I think if anything, it's going to make the Bitcoin network more decentralized, more focused in democracies, and probably greener as a result. And those three things are things that are very positive. So anyway, that's all to say short-term pain for long-term gain. And I think in China's case, it's great that they're, pursuing blockchain initiatives in other ways. But if you ignore the crypto asset world and the world of Bitcoin, you're going to lose a lot of talent. You're going to see a lot of capital flight, and you may miss out on being one of the sort of leading centers of innovation in this new era.
Well, I think that's a very good point. And for observers, I mean, this is sort of a two-headed approach that's happening in China. That on the one hand, they're cracking down on crypto, but on the other hand, they're investing massively in blockchain. Like there are half a dozen centers in China where there are billions of dollars coming from regional and also the national government into building up blockchain technologies. The last time I was there, which was a while ago, and it won't be for another while because the government just said no foreign travel to China for another year. Anyway, last time I was there, I was introduced by the vice chairman of the central bank, vice chairman of the Communist Party, and a CPC, and he read greetings from Xi Jinping. And the president of China is providing all of this evidence on why blockchain is so important. And he says it's like one of the most important technologies for China going forward. But I don't know if you can have an effective national blockchain strategy by banning crypto, by making it so hard for these crypto activities to function.
Yeah, I would say that you can't. I think those two are inexorable. I mean, you could make the argument that the Chinese have invested a lot in the Chinese internet. The Great Firewall of China is a massive undertaking that's required huge investments of capital by the government. But is that something that enables the internet to reach its full potential? It creates a version of the internet, but it's maybe not the internet that we're accustomed to, right? And so I think the same kind of analogy could apply to this space as well, is that could be a big investment in CBDCs, and they could be harnessing this technology and using it for all manner of things. But if you're kind of cutting out part of the raison d'etre of this technology, which is, as something to broaden inclusion, to enable freedom of financial expression, to create innovation that happens outside of banks and governments and in the technology world, then you're going to be limited in what I think you can achieve with that kind of strategy.
And you mentioned privacy too. I mean, that's an obvious reason why the government would favor central bank digital currencies as opposed to community-based currencies or even corporate currencies, because as someone said, I wasn't the first to say this, but their partner in moving to a central bank digital currency is Big Brother. And of course, they'll be able to monitor the most detailed way the activity of citizens. Every time you spend a dollar, they could know what you're doing. So, I mean, Orwell had no idea how detailed the data could be about individual citizens. And then this data is not just for their interest, but it can be used against you. So we already have the social score in China where, you don't pay a parking ticket, or worse, you go on a demonstration or something like that, and your kid doesn't get into the, or maybe you show up at the border and your passport doesn't work or something. So the stakes in getting all of this right are pretty huge, not just from an economic or prosperity point of view, but in terms of human justice and basically creating a next generation of civilization.
Yeah.
I was noticing some stuff about remittances this week. There are companies that are, you remember we talked about this in Blockchain Revolution many years ago. It was a central thing in my TED Talk. And it's been slow to move forward. But now there are a bunch of companies that are getting into this space really, really quickly. But then there are those who argue, well, no, central bank digital currencies are going to enable this. So we don't need to have private sector initiatives because once you have a digital fiat currency, money can move around. at the speed of light and across borders and with very small FX charges. I mean, what are your thoughts on that?
Well, I think that there's going to be innovation from both sides. But if you were to ask me today where most of the innovation is happening, I would say it's in the private sector already. It's in the world of stable coins, for example, and in Bitcoin remittance services. Now, we know that Bitcoin has a lot of limitations for remittances. Chief among them is that the Bitcoin network does not process that many transactions. Fees can be high on the network. And also, the asset itself is volatile. So a lot of people are not comfortable with that. So there are lots of people in this developing world that receive remittances in Bitcoin, but it's not something that's in the billions of people, right? And that's the kind of scale that you need in order for this to work. Now, maybe we'll get there. Maybe the Lightning Network and some of these other, technological layer 2 solutions can allow us to make the network more scalable. But in the meantime, there is a really interesting development, of course, which is the growth of stablecoins. Stablecoins are digital assets that are pegged to assets in the real world, usually US dollars, and they allow people to move money, fiat currency in effect, peer-to-peer over various blockchain networks in a matter of minutes or seconds, and to do so at little to no fee. So today, stablecoins are primarily used as a medium of exchange in the crypto asset world, but there's no reason really why they couldn't also be applied for other real world use cases such as remittances. And this is not some pie in the sky, proof of concept experiment. The value of stablecoins today is in excess of $100 billion. Having grown from a couple of $1 billion just 2 or 3 years ago. And some stablecoin pairs with other cryptocurrencies, meaning their trading pair, the other asset, are some of the most liquid markets in the world. So this is something that we've got proof of concept on that is being applied in a battle-tested environment with where billions of dollars of money and assets are on the line, and therefore could easily be applied to other kinds of use cases, in my opinion. The opportunity with CBDCs is also very significant, though you have to wonder if I'm a Canadian person, of Filipino origin, and I'm sending money home to my family. I want to send Canadian dollars. They want to receive a Filipino peso. And that's not really how stable coins work. You would need to have sort of a stable coin of both, or I should say a CBDC of both of those different kinds of assets. And I think in order for that to work, probably what's more likely is that, people increasingly use some sort of US dollar stablecoin or government issued CBDC from the US as a global medium of exchange, simply because it's something that is accepted in many different places, regardless of where you are. And that's an interesting sort of side effect of this, which is that, one of the things people have argued is that all of this innovation in crypto assets could dislodge the US dollar in some way, make it more marginalized, when in fact the opposite could be true. The US dollar stablecoins have demonstrated the primacy of the US dollar as the go-to medium of exchange in this ecosystem, which I find very ironic, but also revealing. So we don't know what the future looks like, but I do think that both CBDCs and stablecoins are going to be the way that this solution happens. Whether or not it has unintended consequences, we cannot be sure about.
Facebook's DM was supposed to solve this problem, formerly, but I got to say that it was always a long shot, but it's a real long shot now, and it's not because that's not a viable thing to be done. I mean, Zuckerberg says that sending money around the world should be as easy as sending a message. But given the political environment in the U.S. with bipartisan House committee now coming in with big heavy-duty legislation to break up big tech, basically, I got to say that that's looking a lot like a non-starter right now. I don't know. Maybe it still has a hope, but.
Well, again, I think you made the point, which is that the problem with DM was not technological, it was political. the government is not keen on Facebook, a company that people on both sides of the aisle don't seem to like very much. If you're on the left, Facebook got Donald Trump elected. If you're on the right, Facebook silences conservative voices. Whatever. I think those are probably both not true. But anyway, it's a boogeyman for everybody, and so there was really no hope in hell that the U.S. government was going to sanction this company to do something that could dislodge the US dollar in some way or marginalize it. So the original DM Libra was a stablecoin made of a basket of currencies, which could have honestly become like a new global reserve currency. And then they paired it back to a US dollar stablecoin. And that's been, the ambitions continue to shrink with that. So I think it's a great idea. I think Facebook could have implemented and done a fine job with it, actually. But I don't think that they were ever going to have that opportunity.
It's this new species of business. 2007 paper I co-authored. We talked about something called a digital conglomerate. And we said we've never seen anything like this, where it can evolve into adjacent or not so adjacent industries because it has this unbelievable asset, which is data. And I think it's a good term, digital conglomerates. Anyone who's interested in that paper, just Google the term. I wrote an article 3 years ago on LinkedIn where we republished some of the material from back in 2007. But this is a good conversation for us later on, because I think the problem here is not fundamentally that they're monopolies. The problem is that they're owning the asset class of the digital age. And the way that we need to approach these things, I think, is very different than traditional anti-monopoly legislation. Anyway, I'll leave that one hanging.
That is a hanging Chad, as as they used to say. No, we'll let that one hang for another What's on Tap, I think.
Yeah. So, and I'm also reminded as we talk about all this that there are things that the banking industry in countries could do to get together and move towards a blockchain-based next-generation payment system. And when the book first came out, I was asked to give the opening talk to the big conference in Canada of the Canadian Payments Association. It's actually called Payments Canada now. And I argued that this would be an extraordinary thing because they're rebuilding the payment system in this country, all the banks and others working together. You could have payments embedded in smart contracts. Essentially smart money. Michael Casey at one of our events, he's now the content head for CoinDesk, was asked what's smart money, and he gave a great analogy or example where he said, well, you send your kid off to university, you give him money for books and tuition, you hope he doesn't spend it in the bar. Well, if the money were smart, he goes into the bar, orders a mojito, and the money says, sorry, Johnny, I don't do mojitos. So that's kind of a funny analogy, but imagine payments that are part of smart contracts that are just speeding up the metabolism of the economy. You could have a payment system that's way more secure because there'd be no major points of failure. You could have a single version of the truth. You could have instant settlement. And this is something that's just sitting out there still for the traditional banking industry to get together and to do something like this. And
Yeah.
it's on my mind a bit because I'm giving a talk tomorrow to an organization in Brazil called FEBRABAN. It's basically the Brazilian Bankers Association. There'll be senior banking people from all across Latin America. I spoke at this thing physically a few years ago. But and these are thousands of people. If you, in 1 minute, if you could speak to the CEOs of all the big banks in Latin America, what would you tell them about blockchain? Give me some good stuff for my talk.
Well, I would say that they're part of the traditional finance world. And what we're seeing in blockchain emerging is this thing called decentralized finance. And decentralized finance is basically this notion that you can recreate a lot of the basic functions of what the industry does. So things like payments and lending and savings and investments and insurance and so forth, with software protocols that operate autonomously online. And there are plenty of examples of this in action. We've actually talked about them previously on episodes. So it's possible that that many of the industry lines that they rely on today will be decentralized. Now, I think probably the solution is going to be something where banks and other financial institutions, because I think that's important, continue to thrive in their own way by embracing and integrating a lot of this technology. So what we describe, in our work is basically this idea of going from traditional finance to DeFi, but in the middle there being what we call open finance, and that's basically a willingness and an openness to embrace and understand how digital assets are going to impact their business. So, for example, crypto asset custody would be a big use case that banks, as traditional custodians and keepers of the treasury for institutions and individuals, might find really interesting. To store and secure digital assets, you need to have a whole different set of protocols and procedures and so forth. Today, the market is $2 trillion, which is now sizable enough that they should pay attention, or $1.5 trillion. But it's our view that most asset classes, whether they're securities or land titles, are going to have the similar kind of basic backbone. And that's to say that, for every asset, there's going to be a public key, like an address, and a private key, a strong password. And a lot of individuals don't want to be their own bank. They don't want to store, all their money and assets on hardware devices that they keep in their house. They'd rather a bank do that for them, honestly. They're off doing something else, living their lives. And so I think there's a huge opportunity for banks to become educated on this. And frankly, if you're in Brazil, you should just look to what's happening in other parts of the world. Look at the United States. In the United States, BNY Mellon, Chase Manhattan Bank, two of the largest custodial banks in the world. BNY Mellon, the oldest bank in America, started by Alexander Hamilton, the first Treasury Secretary and Broadway star, is decided that it wants to get into crypto asset custody. And probably that's because, A, there are big companies out there that need services for Bitcoin and other traditional crypto assets. But B, longer term, this is going to set them up with the infrastructure they need to custody securities and every other kind of asset down the road when eventually they're integrated with this kind of technology. So open finance is where you need to focus, become educated on DeFi, but understand that the world of traditional finance as it exists today is being disrupted.
Traditional finance to open finance to DeFi. I guess the scenario is to avoid full-on DeFi because that's called disintermediation. You're in the middle basically, and if you're in the middle, technology can eliminate you. We've seen this before with the internet, of course.
Yeah.
It's this huge challenge. I use the word. It's one of these words that never really took off, but in the digital economy in '95, I said, there's a new thing that will arise called reintermediation, the opportunities to create new value in the middle. But I argued that the leaders of the old middle will typically not be the ones to create the new middle. And we saw that with the internet, that it wasn't Barnes and Noble that created a new middle between publishers and readers of books. It was a different company. It's now the largest company in the world, close to it. So it really comes down to leadership, I guess, and cracking out of an old paradigm. Yeah, we have some announcements here. On July 21st, we're hosting a webinar, the Blockchain Research Institute, about AI, IoT, and the battlefield of things, exploring military 4.0 and cybersecurity. And we got some heavy-duty guys from the U.S. Military involved in explaining that. It's going to be interesting. Platform Revolution, our next book in the series of books. First was Financial Services Revolution, edited by Alex. Then we had the Supply Chain Revolution, edited by me, and now Platform Revolution is coming out. It'll be available in the end of September. You can order that now on Amazon, and go check out at Blockchain Revolution Global. Check out the Enterprise Blockchain Awards. Nominations are open. and we'll be having a big fancy black tie awards ceremony on November 16th. And there will be more information about that too. So that's what's on tap for this week. See you soon.
Take care.